Cool. And I'll let people in. All right, I start to see some people trickling in. Welcome, welcome. Give another couple seconds here, and then we'll go ahead and get started.
And could you guys hear me okay, by the way?
Yeah, we can.
Perfect. I got like a new microphone here, so I just want to make sure it's working.
Yeah, sounds great. And slide looks good as well.
Great.
Um, all right, looks like we got a decent mass of people already logged in and joining. Welcome, welcome. Thanks you all for coming today. For those of you who I haven't met yet, I'm Troy. I lead Issuer Success here at Netcapital. This is part of our fundraising masterclass series, and today's topic's all about a VC's guide to getting in front of investors. And we are honored to be joined by Robert. Robert is VC, angel investor, and founder. He's the number 2 at Evolution VC Partners, who invested in Sweetgreen, Beyond Meat, Carta, sure, a bunch of other ones, but those are some of the biggest. He's also GP at Timeless Ventures. He's co-founder of DECKO and WeRaise. A couple housekeeping items before I hand it over to Robert. So this event's going to be recorded, and we'll be sharing it with you all, along with anyone who's not able to attend after the event. We'll also be sharing Robert's contact info with you guys, along with more information about WeRaise and how they can help you with your Netcapital offering. If you have any questions during the event, feel free to drop them into the Q&A feature or the chat feature, and Paolo and I will moderate as necessary. Otherwise, we'll save some time at the end for Q&A as well. But with that, Robert, I will let you take it from here.
Okay, awesome. And all right, cool. And first of all, thank you for the intro. And yeah, why don't we dive right in? I'm really excited to talk through all of this with you. That was my skateboard, if anyone heard that falling off my wall, but it's in a secure spot, so we're actually all good. Anyways, it's great to connect everybody. Thank you for hopping on today. Like Troy mentioned, I'm a founder and a VC. And today I'm going to give you a little bit of my perspective on raising capital from the perspective of both. And hopefully this will help you all close out your rounds and make the most out of your not only your raise with Netcapital, but your future raises in the future and things like that, and really think through, a capital strategy around how you're talking to investors and how you're communicating with them. So just diving right in here. Quick background on me. Troy gave a quick intro, so I'll spare you all the details, but I've been working in marketing and venture capital since I was 17 years old. Again, I'll spare you the details, but this is what I've dedicated my entire life to, is helping founders get in front of investors and either deploying capital from the perspective of an investor or raising capital from the perspective of a founder, or building services that help people do both. On the investor side, I'm second in command out of Evolution VC Partners. Like Troy mentioned, investors in about 300 companies, ranging from pre-seed to Series E and beyond, into what we call culture tech, so things we use every day. Think companies like Sweetgreen, Beyond Meat, Via, Carta, Masterclass, and a number of others. In addition to that, I'm GP at Timeless Ventures, and then I'm an angel investor into more moonshotty kind of things. I invested in one called Figure AI, which is building humanoid robots. I'm an investor in OpenAI, which is obviously everywhere. An investor in one called Colossal, which is bringing back the woolly mammoth. I try to get weird with it on my personal investing. But the thing that all these companies all have in common is that they're all raising money. And I'm sure you all know this. It almost always sucks, right? It's a massively different part of your business, right? It's a totally different set of people who aren't your typical customers, but they make decisions their own ways. They have their own processes for getting in front of them, their own processes for getting them engaged and getting them over the finish line. On top of that, they have their own macroeconomic forces that define, whether or not and how they're going to transact. And keeping your finger on the pulse of this is this really difficult additional role that you have to play as a founder, on top of knowing everything about your market, on top of knowing everything about your product and communicating with your customers. You also need to be good at raising capital. And hopefully today, we'll give you some tips that you'll be able to use that'll help you get there. So you get the idea of what we'll be covering today. We're going to be talking about most of this from the perspective of WeRaise. WeRaise is our company that helps founders scale their investor outreach and connection. Now, this could be in relation to either a Netcapital campaign or in relation to an institutional campaign you do later on. But the basics of it are pretty simple, what we've been able to accomplish. We've been able to collect and source what we call investor signal data. Basically, we're really good at figuring out what investors are actually interested in, not only on a high level by industry and stage, but also internally what types of founders attract certain types of investors. What things should you mention in your outreach emails to them that'll get them hooked? What information should you include in your deck? We maintain all of this information about what investors are actively investing in and what they're actually interested in investing in. And we use that to help founders get in front of investors. Today alone, we've set up about 109 investor introductions for the companies that we work with. And those numbers continue on a day-to-day basis. Because of our signaling data, we're exceptionally good at keeping our finger on the pulse of where the market is and helping founders get in front of investors in a way that's actually meaningful. On average, the average company working with us is connecting with about 40 to 80 investors every single month that are potentially interested in what they're doing. Now, with that in mind, let's dive into some of this. First, we'll start with some important rules for fundraising that are going to be foundational to the rest of our work together today. So the first is that it is a numbers game. Okay, at Netcapital and what you guys are going to be doing there on the Reg CF side, I'm sure you know this in detail. There are millions and millions and millions of potential investors for you all. Just over 258 million potential investors for you all. You don't need 100% of these investors to convert. You need a fraction of a percentage of them to convert for your round two close. And so it is a numbers game. The other thing that's important, and I'm sure some of you are feeling this right now, it is not instant. It is not an automatic process. You don't just open and close your round and the checks are there. Think about how hard it is for you to get your product in front of customers, right? You're building something that's inherently novel that they may not have heard of before in the past, that they may anchor to other competitors of yours or to other alternatives that they've tried in the past. Just like you're selling a product and trying to build awareness for your product to customers, or your service to customers, you need to build awareness about your company to the investor community. Marketing to investors is extremely similar to marketing to customers and marketing to B2B types of enterprise clients, in the sense that you have to introduce what you're doing to them. By nature, you're also probably running something that they've never heard of before because you're doing something new and unique. And so all of that points to the fact that this is not instant. There's no big marketplace for this. There's no stock market to go to invest into startups, right? The closest you'll find is probably even something like Netcapital, right? But, even Netcapital is, there's 67,000 plus deals that happen every single year, and they're not all living in one place, which means all the investors are in different places. And so what you need to do is find a way to consolidate this massive breadth of different investors around your company. And so it is this big kind of wild west of different ways to meet people. And I'll tell you about all the different ways that I've met investors in my first company, including, a dude that happened to just live in my building lobby, another guy who I was pitching a customer in front of a hotel that was super fancy, and I happened to overhear that a guy was living at that hotel. There's all sorts of different ways that you'll meet investors, and all of them are going to be non-traditional. And so remember, this is not an instant game, and this is going to be a part of your workflow as a founder. The next thing to know is that you only really do get one major chance at the ask itself. When investors are making an investment decision about you, they're making an investment decision about you, meaning that is going to be a binary yes or no. And so you have to, before you get them to answer that binary yes or no once, You have a lot of time to warm them up and to get them there. And I'll show you exactly how to do that. This is per round. On top of that, some important tips. Do not let the tail wag the dog. You're building your business. You're running your business. The investor community is going to have their own perspectives about this stuff, but I hand out advice all the time that I forget the next day. You guys are the ones that have to run the company, that are putting your names on the company, that are signing for the company, putting your reputations at stake for the company. You are always going to know more than your investors. Do not try to build your business around investors. It will do you no good. Investors will see right through it, for one. And two, they're backing you. If they wanted to run the companies themselves, they would run the companies themselves. They're backing your ability and your vision, and they're going to trust and defer to you as the founder. And so really remember that and internalize that. Relationships are paramount to this entire process. They're building trust in you, especially angel investors and Reg CF investors. They're going to be building relationships with you. And while you can't probably take thousands of individual investors out for lunch and ball games and things like that, what you can do is find a way to maintain a relationship with these people at a level of scale by keeping them apprised about your growth, by keeping them up to date about your journey as a founder, and by helping them build a personal connection with what you're doing. With that in mind, they do want to build with you. While they don't want you to build your business around them, they do want to be supportive. They're going to have advice. They're going to have other things that they're going to want to do to help you. I remember in my first time I ever raised money for a company, I was fresh out of high school. It was the summer going into college, and I had found this deal. I was aiming to raise, I ended up raising just south of $1 million for them. And this one investor wanted to put in $5,000, which was little to nothing compared to my goal. But I said, you know what? Sure. Fuck it, here, put in $5,000. He put in $5,000 and he said, by the way, I get drinks with these investors. Once a week, we do a little wine night and we talk about deals. You should stop by and show it to them. I told them about it and I think they'll like it. So I did, and I closed another $300,000 that night. And so no one investor is going to be too small, would be my big piece of advice. Every single investor is now invested in the growth of your company. They care about the growth of your company. They want to see their investment in your company succeed. And so think of each of your investors, all the more so with the Reg CF raise, all the more so, think of all of your investors as nodes that you can tap into to either get in front of customers, get in front of other investors, get in front of the press, get in front of new hires, and all these other things. All that relies on you maintaining a good relationship with these investors. Keep them apprised of these things. They know that your startup is a journey. They don't expect you to have it all figured out. By any stretch, they do not expect you to have it all figured out. Instead, that's priced in. If you had it all figured out, you'd be a multi-billion dollar business, right? But you are an early stage company, and they know that, and they're investing in that. Do not worry about a warm intro. Investors don't necessarily need a warm intro. This is a good segue into, I just noticed a question pop in about, should you pay for intros? There is no such thing as a paid for warm introduction. If it is a paid for introduction, it is no longer warm. I'm sure many of you have come across these people who say, I have a network of investors who come to me for trusted deal flow. And if you give me 10,000 bucks, then I'll put you on my deal flow list that goes to these investors. I cannot stress enough, 100% of those investors know that that recommendation is 100% bullshit, because they know that it's being paid for by the company to that person. We do not trust that person. They might have found our contact information. They might have convinced us that they were an investor for, a couple sessions, a couple meetings. But in reality, the second that they get caught doing that, their signal goes to zero. Your best bet is to either go cold and reach out to investors cold, because they like talking to founders directly. They do not like working through intermediaries. So either go to investors cold. You'd be shocked how well it works. I have personally led rounds off of cold emails, or work through your existing connections to be able to get there. In terms of what you're going to be doing with NetCap, What you guys are doing here is going to be a lot more on that almost cold side. You're not going to be trying to generate intro paths to thousands of individual investors to try to get them to cut small checks. Instead, you'll be running what looks more like a sophisticated outbound campaign, which will include not only cold email and things like that, I'm sure, but also marketing, ads, and things like that. And so all of that is cold. Those scenarios, you should almost never pay for a warm introduction. And even when it comes to raising institutional rounds, you should not try to pay for a warm introduction. Again, everyone on the institutional side sees right through it and your money is being wasted. Instead, go cold and go broad. And remember that it is a numbers game. So now that we've covered the basics, now we're going to dive into some things a little more tactically here. So we're going to talk through the different investors you'll meet and how to tailor your pitch to each of them. We're going to put a little bit of a more specific weight on numbers 1 and 4 there, on angels and online audiences and how to tailor your pitch for those. But you are going to encounter venture firms and strategic investors throughout your company's journey in general. So it might be useful for you to just have a basic understanding of how those work regardless. So with that, let's dive in. I'm sure everyone knows these two people. These are Mark Cuban and Peter Thiel. Mark Cuban, the famous investor from Shark Tank, Peter Thiel, the first investor in Facebook, one of the founders of PayPal, and so on and so forth. What's cool though is that they're only one of 300,000 investors who have made an angel investment in the US. So even though you've heard of these two, there's hundreds of thousands that you probably haven't heard of. This is where it gets even cooler. Those 300,000 are just a part of the 4 million investors who can actually make angel investments. These are people who make over $200,000 a year or $300,000 with their partner. They're what's called an accredited investor, right? Meaning, right, that of the 4 million people, less than 10% have made an angel investment, meaning that your company can be their first angel investment. This is where it gets even more interesting for you all, is this number. This is the amount of people in the United States that can basically invest into Reg CF offerings, right? These are Americans over the age of 18, right? That are able to invest in, don't have to be accredited investors. So while most founders are vying for the 300,000 investors that have made angel investments or the 4 million that can, you have 258,418,544 other investors that you could be hitting that other people can't be hitting. All of these investors make decisions the same way. It doesn't matter if they're putting in $1, $100, or $100,000. Angel investors make decisions in very similar ways, which is extremely personal decision-making processes. They are investing out of pocket. These are just regular people like you and me with additional extra cash to be able to invest. So they may not have a mandate to invest at all, right? They could be deciding between investing in your company and going on a sick vacation or getting a new Mac or something like that, right? So your deal has to be more compelling than all the other things that they could spend their money on. That's their money. They have no need to invest it. So what actually gets them to transact? Well, personal relationships with the companies they're investing in. Now, that could be a personal relationship with you as the founder. I've had plenty of investors in the past who've said like, I don't fully understand this yet, Robert, but I trust you and I know you and I'll back you for it. This could be a personal relationship with the problem that you're going out to solve. I had like been dreaming of this like one kind of to-do list company that would sync with all of my things and whatever. And I had spoken to a founder who happens to be building exactly that. I backed him immediately because it was solving exactly what I needed him to solve. Or it could be, a personal relationship with the product. In your case, since you guys are marketing to regular everyday investors, retail investors, chances are many of them are users of your product. If they're users of your product, then they have that personal relationship that we're talking about here. And there's perhaps no greater signal to future investors that your product is working, then not only are my customers resubscribing or repurchasing, they're investing in our growth. They want to see this business succeed. They love what we're doing so much. And so you have this opportunity that other people don't, which is you have a customer base who probably already knows about you, probably already really likes you, and is probably rooting for you that you get to call from. Those are going to be extremely valuable sources of angel investor leads. The last thing to know about them is that they're very social about how they invest, both on the intake and on the other side of that. On the intake, they are making investment decisions socially. They're usually congregating into angel groups, or they're talking on forums or comment sections on your Netcapital profiles, or they're asking questions. These are some of the ways that they'll be social. They are talking about deals with other people. They don't have diligence teams. They don't have analysts. These are regular people. So they're relying in part on the wisdom of the crowd to invest. So social proof becomes extremely important. Showing momentum behind your raise of other people investing is going to be extremely important. We'll talk about that as well. And on top of that, they may even be congregating in angel groups where they are meeting with other investors to say, hey, let's look at this deal together. Maybe one person's a doctor, another person's a lawyer, another person's an accountant, another person is a product manager at Meta or something. Each one of them is then going to bring their own perspectives to vetting the deal, and then they'll, as a group, make decisions together about whether or not they want to get involved. Extremely common. That's on the intake. On the outtake, they'll then be your biggest advocates. They're going to talk about your deal to all the other people that they know. They're gonna try to promote your product to new customers. They are your not only angels but evangelists. 100% of the time, your angel investors are going to want to root for you. They are not investing just to be naysayers in your company. So really activate them and lean into that social side of what they do. Next up is just venture capital funds, institutional investors. Very different than angel investors. And so this is something for you to just pocket as you think about your next rounds. The way that they make money is extremely important. It's called a 2 and 20 model. I'll give you an example. Let's say I have a $10 million fund. I will get $200,000 a year or 2% of the fund to manage the fund. So I get $200,000 a year in cash to just manage that $10 million. Now, that might sound like a lot of money, but I have to use that $200,000 to hire and pay analysts, associates, principals, pay for my office space, pay for legal fees and closing fees and annual audits and everything else that's included in managing a fund. So that $200,000 goes pretty quickly. I am not in it for the $200,000. I am in it because what happens if that $10 million turns into $110 million? In other words, I have $100 million in profit from that fund. I, as the fund manager, would walk home with $20 million, 20 million big ones that I didn't have to come up with $20 million to invest. I had to raise $10 million and invest it properly. I do not care about the $200,000. I care about the $20 million. Here's the other thing though. That $20 million is far from guaranteed. If you think returning for your company is hard, imagine how hard it is to return a fund, which is a collection of companies. If you think about that $10 million, let's say they made 100 investments of $100,000 with that $10 million, right? 9 million of it, 90 investments of theirs, straight to zero. Gone, $9 million burned, right? Going to zero. There is no in between. There's no getting out at 20% less than you put in like you can in the stock market. It goes to zero. Then 700,000 of it, so about 7 deals, will return exactly $700,000. Meaning they didn't make money, they didn't lose money. They were just in the black, in and out. 3 of those deals will then return the entire $10 million fund, right? And deliver the return and get them to that $110 million mark. So they are not trying to turn $1,000 into $2,000 or $2,000 into $10,000. They're trying to turn $100,000 into $100 million or $1 million into $1 billion, because your deal not only has to return itself on a deal by deal basis, but has to make up for all of the other losses that their funds have incurred so that they can get their management fee, their carried interest. and walk home with that actual percentage of profits. They make decisions more analytically. They're typically putting together investment memos and then taking those memos into committee to make decisions. I'm just going to take a second. Feel free to screenshot this. This is useful for everyone. Whether it's, raising through Netcapital or raising through friends and family or raising through venture capital funds. These are kind of the common things that investors are going to be thinking about as they're looking at your company. So just go ahead and take a second. Feel free to screenshot this. This is also being recorded and delivered later, but take a look at this. And then in about 3 seconds, I'll move on to the next slide. 3, 2, 1. I hope you guys all screenshotted it. Now we are moving on. Next up is corporate and strategic investors. These are big companies, established companies that invest into startups. These are your Apples of the world, your Microsofts of the world, your Tyson Foods, you name it. These are established businesses that exist to invest into startups. They'll either invest off their own balance sheet or they'll invest in a separate fund. For example, BMW created BMW Ventures, which is a separate fund that exists to invest into these things, or Google created Google Ventures, which will invest in things that are even competitive with Google. So it gives them a little more flexibility. Or they'll invest right off the balance sheet. Here's the thing with these that make them interesting. They are not as much economic animals as other types of investors. Let's take that same $100,000. Let's take that $100,000. It turns into $100 million, right? Wow. Wow, 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 wow. Like what a venture scale return. Huge deal. That's amazing. Every venture fund on the planet would be pumped with that outcome. To Apple, that's a rounding error. $100 million means nothing to Apple. They probably make that in a day or less. And so with that in mind, they are not interested in trying to make your investment deliver a return on a deal by deal basis. Instead, they're much more interested in how your investment fits into their larger company interests. Now that could be, building a deep partnership with you to get access to your customers, getting access to your tech to speed up their internal processes, could mean being the first look at your company for M&A when the time comes because they're on your board. They're usually investing for a reason outside of just wanting a cash on cash return on their investment. Here's some notable examples of that. Microsoft's investment into OpenAI is an excellent example of this. I didn't see this deck, but I have to imagine it had a lot less to do with like OpenAI on the fundamentals and much more to do with how OpenAI and Microsoft can work together. And you're seeing that investment bear out today, right? You're seeing Bing powering all of ChatGPT search. You're seeing OpenAI's products embedded directly into PowerPoint, Excel, etc. You're seeing this partnership in action today. It's having a very real world effect. Now that's happening because Microsoft owns a huge stake of OpenAI. And OpenAI probably had their pick of which larger company they were going to let invest into them and get this close with them. BMW invested into a portfolio company of mine called Natural Fiber Welding. And BMW is obviously the automotive manufacturer. Natural Fiber Welding builds plant-based leather. BMW wants a first look at that plant-based leather before Mercedes, before Audi, before any of the other kind of automotive manufacturers see it, because they all want to be carbon neutral by 2030, and their leather seats are a huge component of that. So if BMW invests into this plant-based leather startup that's making plant-based leather that looks good, feels good, and works, then they're going to have a leg up over BMW and Audi when the time comes. And that's so worth the check that they put in. Next up is Research Frontiers' investment into Zuli. You probably haven't heard of this one because this is the first deal that I ever did in all of venture. I used to work at Research Frontiers. I was their director of market development. Publicly traded technology company. They make glass that switches tints from clear to dark. And we were entering into the architectural market with our technology. And we needed a controller for our technology to switch the tints from clear to dark. When it was in the Mercedes S-Class, SLK, etc., Mercedes created the button that was embedded into their car. We didn't have to develop the actual physical button. It sounds like a small thing, but it's important. Or when Airbus or one of these other people put it into their planes, they were doing it, they were building the controller themselves. we never built our own controller. But if we wanted to enter into people's homes, we had to build a controller that was consumer facing. Now, we were just a bunch of chemical engineers. We didn't have software people. We didn't have UI, UX people. We didn't have hardware engineers or any of that stuff. We were a bunch of chemical engineers. And so we found this company, Zuli. I was sitting in a detention and I found them. And they were like building a universal smart home controller through these smart plugs. And anything you plugged into those smart plugs could be controlled through their app. I was like, that's interesting. I plugged in our tech into it. I have a version of the glass you could plug in. I plugged it in and it worked right out of the box. I said, oh my God, I've never seen that before in my life. Here we were like racking our brains about how we were going to do this. And these like 8 people out of San Francisco did it by accident. And that was incredible to us. And so we ended up investing and the company went under, right? They got bought out by Lenovo, no, by Google for pennies on the dollar. But we consider that investment a success because we saved hundreds of thousands of dollars in R&D costs. And we were able to speed up our timelines to be able to enter into the architectural market by a factor of years because we didn't have to collect and test and build all these different things. Next up is online audiences. The big thing with online audiences, and I'm sure you guys are already seeing this, these people are making investment decisions on their own, and they just need an overview of your company that gives them everything they need to make a decision. Now, be careful not to give away information that you don't want people like your competitors or something like that to know. You are talking to people at scale, and so be careful about the information that you give out with that. With that in mind, you don't want to be talking to people if you don't think you don't want them invested if you don't think you could trust them with your company information as well. And so there is a bit of a delicate balance you have to play. The big thing to remember with online audiences is that this is almost exclusively angel investors. Institutionals and things like that aren't going to be going onto Netcapital or onto AngelList for that matter, or one of like, which is, said was originally trying to be a market. No place are they going to find deals, right? Angel investors will go to Netcapital to find deals. They will use that capital, be marketed to by companies on Netcapital to find deals. So think about them as your customer segment that you should be thinking about here. So remember how they make decisions socially, through personal relationships with the product, the team, etc. And they are investing out of pocket, meaning they have no mandate to have to invest. And so remember that as you're reaching out to them. Now, all of this is with the attempt to avoid the dun-dun-dun, the stale raise, right? The stale raise is every founder's worst nightmare. The idea of the stale raise is pretty simple, right? It's a raise that's perhaps been on the market for way too long. And because it's been on the market for so long, no investor has stepped up to lead. Because no investor has stepped up to lead or no investor has invested in the round yet, there's no conviction about the round to go around. Remember, investors are extremely social, so they're looking for social proof. If there's no social proof to go around, it's very hard for them to get the own conviction that they need. Basically, if no one else is doing it, what does everyone else know that I don't know? Maybe they're seeing something that I don't see that's preventing them from investing, and it just makes it that much harder to get the next investor to get conviction about your company. So how do you avoid the stale raise? One word: momentum. It is the number one most important thing that your raise needs. You need to be in a consistent closing motion throughout your entire raise. What that means is that no check is too small. There are checks that can happen too late, but there's no check that is too small. Start to accept any and every single check you can accept. If you have someone who's interested in investing $1, write them a note for $1. Because what that lets you do is go out to other investors and say, hey, the round is starting to close. Investors are starting to put in cash, meaning other people have done the work on this and they've gotten conviction about this and are ready to do the deal. Always be in a closing motion. All you have to do is get the party started. Accept the first check that you think is reasonable that you could get your hands on. I remember when I was going out to raise money for my first company, I was going through a stale raise. I was trying to hold out for these like amazing terms. By the way, is everyone hearing me okay and seeing me okay? Okay, cool. Just want to confirm. And so I remember when I was going out for my first raise, I was going through a stale raise. It had taken me like months to get any conviction from investors on like my terms and things like that. Finally, I had one investor offer me terrible terms. I didn't take them. Instead, I had this other investor who was like ready to just put in whatever amount, who was like a friend of a friend. Was ready to put in a small amount. It was like, don't worry about the valuation. You just kind of come up with that. So we wrote up terms and he invested on that valuation. He put in like less than, I want to say less than 10% of our round. Uh, and because of that, we closed the round in a month. Because all of a sudden, the terms were set, investors were cutting checks, and now every investor you've been talking to knows, for lack of better words, that it's time for them to shit or get off the pot. Now they need to know basically this deal is moving with or without them, right? And if they don't get conviction now, they are never going to be able to get in at this valuation again. And so momentum becomes your best friend as it relates to raising money. Collect every and any single check you can early because once those gates open, it makes it so much easier to close out that round. Momentum comes from planning, right? You do need to warm up your investor introductions, your investor leads. Now, in your case, as you guys are doing this, this will look like a few things, right? One, at Netcapital, you start with a friends and family raise, right? This is an excellent way to build that momentum. You already have pre-existing relationships that are warmed up with these investors. Start there. That creates the momentum that you need to be able to close this out and give social proof to all the future investors that you're going to be talking to. As you go out to raise money from institutional investors, stack your investor meetings. And when I say stack, I mean stack them down to the half hour so that when it comes up to minute 27 on a call and an investor asks you some annoying question, you get to say to them, that's such a great question. I'm so sorry. I have a call with another fund right now who's super interested. I do need to get back to them. But if this is important to you, why don't you send me an email? You'd be surprised how much they forget about their question and they just end up like backing because they know other people are looking at the deal. And so it's a great way to just do that. Keep everybody updated, right? This is probably investors' number one biggest pet peeve is the company that disappears for a year and then only comes back when they need them to invest more money. Hate those people. 100% of the time you do that, you get back emails from investors being like, hi, good to hear from you again. So what has been going on at the company? I can't believe that we haven't heard anything about this. I'm sorry, I can't continue to back this. Or worse, I'm definitely not investing with you. F you. I don't want to hear from you guys again. And we've considered this a zero and good luck to you. Keep everybody updated throughout the entire process here. As you're going out through your raises, even before you've asked them to invest, share news about the companies. As you're going through your Netcapital raises, send out drip campaigns that share new pieces of company performance and traction and growth and things like that that help people know that this company is continuing to grow and has exciting things about them. That's all going to become really valuable as you're trying to get them to be warmed up to transact with you. They're not all going to invest 100% of the time right away, right? Have you ever bought something based off just one ad that you've gotten? Probably not. They say on average, it takes 7 touch points between a brand and a consumer to get them to actually transact. You should think about your relationship with investors as very similar. They're going to hear about your company, hopefully from a few different places, either through your direct outreach, press, news on social media, ads, their friends, etc. Right? Take that kind of 360 approach to making sure that your investors are hearing about you in all these different ways and keep them apprised of the growth so that they can continue to build that relationship with your company and they can see that your company is continuing to grow. Always have your materials ready to go too. Keep your deck up to date. Keep your data room up to date. Now, in your case, they're not going to probably need a data room if they're going to be looking on your Netcapital profile. So keep your Netcapital profile up to date. These things are all going to be extremely important. You don't want to be caught in a situation where you're giving out one piece of information, but then your deck says another thing, and then your Netcapital profile says another thing. Now there's too many pieces of truth to go around for anyone to know which one's actually the source of truth. And so always make sure your materials are consistent and updated. It reinforces the trust that you'll build with investors. These are some of the things that you'll usually need. Again, with your net capital profile, many of these things are going to be different. Like you don't need a data room. Your company blurb is already going to be in customer references, bios, and a demo, and your deck, and all these things are likely already included in your net capital profile. If they're not, make sure that in some way, shape, or form they are integrated into there, and the net capital team will be able to help you guys do that. But regardless, these are some of the things you should always kind of maintain and keep ready to go. This is kind of that three-step fundraising method I was talking about earlier. Build relationships, soft circle them, and then collect your terms. In your case, it is again very different because you are advertising an already active raise and soliciting it online and en masse. And so rather than having to go the entire route of playing VCs against each other and things like that, instead, in your case, it's much more focused on those 7 touch points with consumers that I outlined earlier. So you want to be able to find ways for them to not only hear from you directly, but also hear from other people about you. Now that could be again in the form of ads, in the form of LinkedIn posts with testimonials or other people talking about you on LinkedIn. It could be press. Then on top of that, continue to share company updates. I'm sure you all have lists of people that you've been reaching out to invest in your net capital raises. Maybe you've only hit them once or twice, or maybe you've only been reaching out to them once every 3 months or so to try to ping them. Instead, treat that as an email marketing campaign. But rather than advertising deals and discounts, you're sharing company updates and company growth and exciting news that drives that social proof and helps them get the conviction that they need. Cold email is your best friend, right? Cold email is the best place to meet these people. This is one of the best places to meet investors, especially angel investors, who especially are advertising publicly that they're investing into things. Everybody checks their email. It's ubiquitous on every single cell phone. They are always there. This is a jumping off point for your relationships with these people. They're not always going to transact 100% of the time over email. But what they are going to do is learn about you via email. So use that as a jumping off point for that relationship that you plan to build with them. And then lastly, do this at scale. It is a numbers game. You have 258 million people that you could reach through this, right? So this is going to be a numbers game. Find a way to build your email infrastructure to allow you to reach out to investors at scale, maintain those relationships, field questions at scale, respond to things at scale, and help them remain apprised of your growth. Here's just one closing template for you all that just might be useful. This is a perfect cold email template, right? And we use a template similar to this that we've created. It's not a template as much as it's the main beats of the story that we want you to hit, right? And this is things like hi, first name, to avoid hello, avoid Mr. blah, 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 or Mrs. blah, blah, blah. That no one talks like that anymore, right? So hi, first name. Then give a quick hook on your company, usually traction, team, and product, right? In this case, this founder had already sold their business. So after selling a recruiting firm to a publicly traded company, I kept seeing the same issue across leadership teams. Matters didn't understand what truly motivated their people. The hook there that I see as an investor, after selling a recruiting firm to a publicly traded company, this guy knows how to take a company over the finish line. Amazing, right? Then an overview on the company. That's what led me to start this company name. Now, companies like Toyota, Mitsubishi, Panasonic, and Denso are using our platform to identify the intrinsic motivations that drive each of their employees, something that engagement tools typically miss entirely. So a one-sentence overview of the company that also shared some traction, a lot of social proof already in this. This founder has sold their company, and now Toyota, Mitsubishi, and Panasonic are all using it. And this is an issue that the founder has understood personally from their experience. Then 3 bullet points on highlights: 450K ARR, 61 paying customers, 116% NRR. Simple, very bullet point and number heavy. That's really useful. So share those highlights. The investor's eye kind of gravitates to them pretty naturally. So try not to bury your stats and things like that. Instead, leave them as simple bullets that you could easily access. And then lastly, you can see here just a quick call to action. In this case, we avoided saying how much we were raising, but in other cases, you could say, we're raising $3 million now to be able to scale our team. Then from there, you leave a call to action. Happy to share a quick deck or hop on a short call, whichever is easier. Appreciate your time. Thank you. And then that's the person's name. This email is what, 6 sentences in total. It's straight to the point, what you'll notice is it doesn't pretend like I've done all of this super detailed research on the investor and their thesis and all the other stuff. Investors know that a cold email is likely happening at scale. Instead, don't waste their time with that. Dive right into your company and why your company is going to be exciting for them. I I know for a fact that you are not Googling my 300 portfolio companies and identifying based on those 300 portfolio companies that I'm going to be a sick bet. You're not a VC and I'm not a founder, right? I, as the VC, know the deals that are going to be relevant to me. You don't have to tell me what's relevant to me, right? Instead, but I also, as a VC, don't know how to start companies as well as you probably do, right? You need to tell me the things that I need to know that are going to be relevant and exciting about your company. Traction, team, and product are usually the three best things to lean on. And so don't waste an investor's time by trying to pretend like you've done all this research on them or all those other things. Instead, just help them understand what it is about your company that is exciting to you, why you started this company, and then help them from there use that to be able to build this relationship. With that, everyone, that's kind of everything. Where most of this information comes from is through my work at WeRaise. At WeRaise, what we do is we scale investor outreach for founders, and we're exceptionally good at it. We've today alone booked over 109 different, at least before I checked on this call, booked 109 introductions to investors for the companies that we're working with. The average company is getting in front of 40 to 80 new investors every single month. And those numbers are only continuing to go up. And in doing that, we're collecting all of this data on what investors are actually interested in investing in. We have a little bit of time now, so if anyone has any questions, I am totally open to any questions you might have.
Thanks so much, Robert. Looks like we have one coming in from Troy here. I don't know if you can see it, or I can also read it out loud for you as well. Let me know.
You feel free to read it out loud.
All right. It says, what is a good strategy when angels say you are too far along for them and the VCs need to see $5 million in revenue before they jump in?
It's a good question. So you're kind of saying you fit in between that like middle space between institutional growth capital and angel investors coming in for your pre-seed. Uh, I would separate out the type of investor. What you're talking about is more of a stage issue, right? Where like you fit in between the kind of pre-seed idea metrics and like the Series A, product market fit metrics that people are looking for. In these cases, almost 100% of the time, what investors are looking for is urgency. They need to know why they need to invest right now. For the early stage investors, if you are past a certain valuation, they're just not going to do it, right? If you're raising at anywhere above a 5 to 8 or 5 to 10, they're probably just going to say I can't do it. Like the reason I invest this early is because I want the sweetest deal on the planet into these companies. When it gets to later stage investors, they're going to be diving a lot more into the numbers. But in your case, let's say you're doing $2 million in revenue, let's call it, or let's say you're doing $40,000 a month in revenue, right? So you're like, not at the Series A kind of benchmark they say, which is $100,000 MRR, but you're, past the idea stage of your business. You believe it or not, are actually in the best of both worlds. You're not an orphan between those two different industries, between those two different investment sizes. You actually have your pick if you do it right. If you talk to the pre-seed investors, and you structure this in a way that is attractive to them, maybe on a safe, then you are by far the best pre-seed deal they've ever seen because you are going to perform better than the other pre-seed companies in your peer group. If you are talking to the later stage companies, to the later stage investors, then the strategy remains the same. Back to what I was saying earlier, momentum, momentum, momentum. What these investors are looking for is a reason why they need to transact now versus watch and wait for later. The ones that are going to say you're too late for them, nothing you can do about those guys. You're too late for them, right? But you aren't necessarily too early for all these other investors. They don't have a need to go invest right now because they're saying, I want to see you hit 5 million. But then when you hit 5 million, they're going to say, okay, well, I want you to hit 5 million, but I want you to get your gross margins up to 74%. You do that, then they say, now I want you to do that on a 6-month repeated basis or something. They're always moving the goalposts because they don't have an urgency to invest. Now, if you start collecting even the smallest checks in, right? $10,000, $5,000, 200 fucking dollars, whatever it is. If you start collecting even the smallest checks in, you get to go back to that investor and say, hey, I appreciate all the questions and all the things that you've been saying. This round is moving. It is happening. We have investors interested and we are trending towards a close. So we'd love to have you involved. We want to make sure that there's room for you. How much are you considering investing? And you'll see all of a sudden their diligence requests and things go significantly down. My girlfriend is at a fund, a pre-seed fund. And one of the things that she often says is that our typical diligence process is a month, but the deal is moving, we can play ball, right? Other funds are the same way. They will forego some of these things if they know that the deal is moving and they don't want to lose out on a deal because they're not checking a box. Investors are very opportunistic in that respect. Similarly, not all venture capital funds are looking for 5 million plus in revenue. Most of them are not, actually. Pre-seed and seed VC funds are going to be your best friends. What you're going to be looking for out of that is what's called institutional pre-seed or institutional seed. Now, these funds, they're typically investing between $250,000 and $1 million into their average check sizes. So they're very good for those kind of like $4 million rounds or $6 million rounds or even $3 million rounds or two that you're going out to raise. Now, as it relates to net capital, if you're doing revenue at all, it's probably going to be a big validator. One of the things that I know from my experience doing SPVs and working with angel investors and things like that is that revenue has been a huge validator for individual and social investors when they're looking at this, because it's clear proof that what you're doing works and that customers like what you're doing. So rather than positioning your revenue as like a value generator, position it as a validator of your business model. Hopefully that helps.
Sounds like FOMO and scarcity are two main principles when it comes to fundraising, based on a lot of
Yes,
what you're saying, Robert.
exactly.
All right, another question came in here as well. How do potential investors look at sweat equity? Is it a good thing or is it a detractor if you've bootstrapped significantly? And if you could also maybe just briefly define sweat equity for people who may not have heard it before, that'd be helpful.
Definitely. So sweat equity or just equity that was done in exchange for services and not in exchange for cash is an excellent validator for early team members and things like that. Um, the only thing you just really want to be careful of there is that you're not overly diluted to the point where like you don't own a significant portion of your company. There's going to come a point where as you're raising more and more money, you're going to get more and more diluted. You're going to own less and less of your company. Investors will start to do the math and they'll say, wait, after we do this round, the founder's only going to own like 4% of the business. They're not going to like continue to push super hard for the growth of this company. There's nothing in it for them. And so you don't want to be so diluted to the point where where investors don't think there's anything in it for you anymore. So just be careful about that. But with that in mind, sweat equity can become a huge validator. Now make sure that that sweat equity is actually happening for some sweat, right? Don't just give, any kind of person with a notable name an advisor position in your company. Those exist all the time. And investors see those advisors on your deck and they're like, okay, great. You managed to give XYZ person some percentage of your company. Congratulations. What are they actually doing for you? That's more what matters. And so as you're communicating it to investors, try to find ways to engage your advisors and have your advisors either on your Netcapital profiles, put a video testimonial or something like that together, or make it very clear what they do to be supportive of the company.
Awesome. And another one came in from Robert here. What if investors ask, how much have you raised when there hasn't been too much yet? And just maybe you could also generalize it to, how do you convince investors to invest if you don't already have a lot of traction or a lot of social proof already there?
It's a great question. There is investors that are going to be willing to be first. What investors are probably asking for when they're saying how much has been raised and it hasn't been a lot yet, they're probably just wondering why, right? So how do you convince investors to invest when like the metrics aren't there and things like that? You don't. That's not what your job is as a founder. What your job is as a founder is to find the investors that are going to be interested at your current stage and at your current metrics. Do not let the tail wag the dog. Instead, take that same time, because here's what I'll tell you from my perspective, right? There is almost nothing you can say to me once I have made a decision, yes or no, about a company that is going to change my perspective on your company. So if I say something like, you haven't really raised enough money for me to like get interested in this yet, there's not going to be much you can say to me that is going to get me to be interested. Instead, what you should do is say, thank you. I totally understand. Why don't I come back to you when the round is closing? And then spend that time closing the round. Go find another 100 investors. I promise you, there is the right collection of investors. There is the right collection of 10,000 investors that make sense for your company. Your job is to go search for them. Do not waste time trying to get investors that aren't interested to try to be interested. You're not going to want them there even after they cut the check. I know the cash sounds exciting, but that cash will get spent. Instead, use this as a way to almost the best investors think about their capital as a service that they're providing to companies, right? And so they have to have real belief into the companies that they're investing in. You do not want a bunch of investors who are naysayers or something like that investing into the company. So if you haven't raised much yet and that's a deal breaker for investors, move on. Go find other investors who that's not a deal breaker for, because there are other investors who that's not a deal breaker for. For the ones that that is a deal breaker for, say for raising more money, you're not going to get them excited about it by trying to tell them something special about the company.
I love it. Main takeaway, don't let the tail wag the dog. My book went that one.
Exactly.
Love that, Robert.
Yeah.
Last question here would be, I think more specific to WeRaise. So your successful fundraise stories are in which sector and industry mainly? Any specifics on per sector would be interesting to know on what you're seeing in the market, whether for WeRaise or outside of that.
It's a good question. So, investor sector interest shifts constantly, right? Like in 2023, everyone was like a pro on Web3 and everyone talked all about Web3. And then in 2024, those same people became pros on generative AI. And in 2025, those same people became pros on defense tech, right? And they just look for the newest buzzword, and then you'll see a bunch of people on Twitter pretending like they've known about this since they were in diapers. It's not true. Most of these investors are wrong way more than they're right, and don't necessarily have one sector that is going to do that. Now, sectors do get hot. How do those sectors get hot? A breakout winner and a rising tide lifts all waves, right? I mean, lifts all boats. And so what you'll usually see is like OpenAI raises $300 billion round. Great. Generative AI must be like the new thing. Now everyone is going to say, okay, could I invest in something that got half as far as OpenAI? Then I would have made $150 billion. And maybe I could invest in something that got half as far as that. And I'll make 75 billion. And you kind of just do that and do that, and it unlocks this like wave of random investor interest for 3 months. And if your company happens to be a company in that sector that's getting that love, you're gonna love it, right? Because all of a sudden, like your deals are just moving over the finish line. Now you can't change the sector that your company's in, to do that. You can't shift from being a biotech company to being a D2C startup that sells mattresses. Like that's not going to work. Don't let the tail wag the dog. There's some things that the investor community is just naturally ebbing and flowing in, like the same things that were popular 2 years ago, investors may not touch now because they've been burned on it. So instead, what you need to do is target your investors by investors who invest into those industries. We have not found an industry that does not raise, like, or that does not get interest out of WeRaise so far from investors. We haven't, because there's hundreds of thousands of investors that we could reach out to. And like I said earlier, there's probably 10,000 investors that exist for your company somewhere if you can find them. So hotness of industry and stage and things like that completely ebbs and flows. And if you happen to be in the exact moment where it's in your favor, fantastic. But if not, do not let that deter you. This is a massive blue ocean of investors, especially now with the proliferation of tools like Zoom and things like that, where all is taking calls from home. So founders from New York are meeting family offices out of Utah who are raising money from investors out in Azerbaijan, right? There's so much now happening all online that I promise you there is a collection of investors that are going to be interested in what you're doing. So again, do not let the tail wag the dog. Do not let market signals kind of drive you to try to change your company. Instead, use it to help you understand why you might be getting some of the interest or disinterest that you're getting.
Awesome. Probably know we're a minute over here, but any last piece of advice for these guys before we wrap up?
Absolutely. My last piece of advice here, guys, um, is keep your foot on the gas no matter what. For do not let your raise hold your company up, right? Investors will see your growth plateau. That doesn't matter if you're going through a raise and that's where your time is or not. Investors will see a flat line of growth and they'll think this company's not growing, not this founder is busy with the raise. And maybe this founder is busy with the raise, but then why isn't the company scalable enough to be able to continue to grow when the founder is not doing that? Do not take your foot off the gas. Don't let the tail wag the dog. This is your company. Investors are buying into it, which means that your company also has to succeed whether or not investors are backing it today. And so continue to meet customers, continue to get in front of those people, continue to grow your deals, continue to try to make your margins better, continue hiring, continue optimizing these things. Venture funding is one piece of your entire founder journey and founder puzzle. And so just remember that and continue to keep your foot on the gas.
I love it. Well, Robert, thank you so much for joining us. Thank you for all the people who came today. I'll be sharing the recording shortly after this, following with more information about Robert and WeRaise as well. In the meantime, if you'd like to talk to Robert, whether about a WeRaise or otherwise, let us know afterward and we will loop you in with him. Again, Robert, pleasure. So many takeaways. We'll summarize and follow up with everyone afterward, but thanks so much for making the time today. And thanks everyone for joining. And stay
Thank you,
tuned
everybody.
for our next event.
And then
Thanks,
I'm just
guys.
dropping my email in case you'll
I'll
share it.
just send it. I'll
Okay,
just send
you
it
got it.
after.
All right,
Cool.
cool. All right, guys.
All right. Thanks
All
so
right.
much, guys. Thanks, Robert. See ya.